Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, December 2nd, 2019. And here are your top stories. The impact of the Schwab purchase of TD Ameritrade, and disrupting finance just isn't easy. Ask Robinhood. It's Social Media Monday, and that means the look at the latest trends in retirement markets, technology, so much more. And joining us back from a recent trip to India and the United Kingdom, Devin Banerjee. He's a senior financial services editor with LinkedIn. Devin, welcome back to the program.
Thanks very much, Jeff. It's good to be back.
It's good to have you back. And I must say that Angela Moore, from senior editor for MarketWatch, did a fabulous job in your stead. We covered some really interesting articles, but it's great to have you back. And before we begin, how was your trip? Because you visited offices in the United Kingdom, and then you also visited your office in Bangalore, India. So how was all that?
That's right. Yeah, it was very productive. As you and I have talked about a lot, our team here at LinkedIn, the editorial team, is growing just at a staggering pace. So I decided to visit a few of our new colleagues and old colleagues alike, just to catch up and share some best practices, what's working, what isn't. So always good to get face time.
Yeah, definitely. And certainly traveling to a great country like India and England must be really neat. I don't know if you got out to do some sightseeing, but really neat to go there, I'm sure. So let's jump right in. While you were gone, or maybe while you were back, looks like Charles Schwab acquired TD Ameritrade, and I would imagine there was a lot of buzz about this on the platform.
Absolutely, yeah. It was actually while I was on a flight, I saw the news release come across, and it had been rumored for a couple of days. So this comes on the heels of those cuts across all of these major brokerages to zero commissions. After that happened about a month ago, we saw a lot of the stocks react quite negatively. So these big brokerage houses did bring in a lot of revenue from commissions. One of those brokerages that took a really big hit was TD Ameritrade. About a quarter in its market cap was cut, which is interesting because Schwab really precipitated these cuts. It was the first to do so, and then TD followed, lost about a quarter of its value. And then clearly now we know that Schwab approached TD for a deal. So it kind of precipitated the drop in value of TD and then swooped in. So this is about a $26 billion deal. It was only announced. The companies say it'll take, if it closes, it'll take about 18 to 36 months to do so.
Wow.
Obviously, the standard in the U.S. is regulators will take a look, although antitrust concern seems to be a bit lower because there are some of these companies with more assets, like actually Fidelity and Vanguard and others. But why this deal? So obviously, after the loss in commission revenue, a lot of these big companies were seeking to diversify their revenue stream. So these companies don't just make money on commissions, obviously. They do custodial services with RIAs and other direct investors and institutions, record keeping, plan design, plan administration. So bringing these two companies together diversifies the revenue mix, obviously gives it a scale, about $5 trillion in assets, a scale that can combat that margin pressure from lost commissions, and obviously it'll have a branch footprint and a merging of its customer base that it can learn a lot from each other. And obviously there are synergies, a lot of the back office work, technical work that these companies do, they can cut a bit there and have some cost savings. So what does this mean for others? Well, for users of these services, for clients, there's still a lot of uncertainty about branding, about service reps, customer service, how that will work. For RIAs, we actually see a lot of RIAs and financial advisors on the platform on LinkedIn coming out and talking about the uncertainty they have, which is to say, a lot of them custody with both Schwab and TD. A lot of them, it's unclear going forward, if they have new clients who come to them with a big account, where they should custody the assets, Schwab, TD, who they should interact with in terms of customer service reps and all that. So a lot of uncertainty, but clearly a big deal. A a lot of people are also talking about what does this mean for some competitors. So E-Trade was thought for years to be an acquisition target. After this deal occurred, shares of E-Trade declined. After some people think, there may not be a deal for E-Trade. And a really big question is, what does this mean for Robinhood? Now, what is Robinhood? Robinhood is about a 6-year-old startup, but actually has north of 6 million users in just that time. It's a zero commission broker. And it kind of, because of that zero commission model, kind of incited these other commission cuts across the big brokerage firms. So what does this mean for them now that they cannot compete on price? A lot of people pointing to Robinhood's focus on its technology, its user experience. It's obviously an app-first broker, and it's kind of millennial appeal. But it'll be interesting to see going forward what this means for Robinhood, which kind of started all this.
Yeah, Devin, consolidation seems to be the norm in the financial services business. You look around, not only Schwab, TD Ameritrade consolidating, but you've had investment managers consolidating. You've got record keepers that do 401k administration consolidating, all around banking institutions consolidating. It looks like this is really just par for the course as fees have come down. You mentioned zero commissions, but fees have come down all around when it comes to registered investment advisors, when it comes to funds. I got to think that this is something that will continue into the foreseeable future.
It's absolutely true, Jeff. I mean, it's disruption. It's an overused term, but it's affecting all industries, and financial services cannot escape it. Some of the interesting conversation that came out on LinkedIn afterward, this comment from Stu Leventhal I really enjoyed, because he said, if you think about the big brokers from a few generations ago, E.F. Hutton, Shearson, First Boston, Solomon, Dean Witter. I mean, these are names people today don't know. People in financial services, because these companies are gone, or if not gone, they were part of mergers, 2 decades ago, and they've totally transformed into the companies of today. So this is the norm, and it has been the case. Disruption has been the case in financial services for decades, and this is just another step, on that path. If the TD brand goes away and is swallowed by Schwab, people of the next generation in financial services will not know the name TD Ameritrade as well.
Yeah, and companies were not meant to last forever, and this is just all part of the system, the capitalist system that we're in, and that's a good thing potentially for consumers. It'd be interesting to see, Devin, how Robinhood does, and then we're going to talk about them in the next segment, but how Robinhood does. You brought that up earlier in this segment with, their one arrow in the quiver was really, hey, we don't charge you for commissions. Now that seems to have been answered, and the question is, what is the impact to them? Will people migrate away? Will people migrate to? And also the potential, whenever you have consolidation in any industry, the potential for service disruption is plausible and possible. And the question is, what will consumers do? Will they go out and take a look and look at Robinhood or Fidelity or some of the other brokerage houses, E-Trade as an example that you mentioned? So I guess, only thing you can do is wait and see.
Yeah, absolutely. And the arrows in the quiver are price and, customer experience.
Yeah.
And so, as we'll talk about in the next segment, Robinhood is really having to focus on those. But as are these others. There are some RIAs that came out and said, look, maybe Schwab did not have the best kind of technology that RIAs were asking for, but TD did. So that could have been one of the many drivers of this transaction as well. So again, these companies are always thinking about those arrows in the quiver, and it drives M&A like this.
Yeah, and by the way, I do remember E.F. Hutton, because when E.F. Hutton talks, people listen. And I remember that. I will always remember that. Devin, stick around, and the audience should stick around as well. When we come back, we're going to talk to Devin about Robinhood, and I'm not talking about Maid Marian and Little John. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We've discussed financial technology or fintech before, and you know, it's just not easy to disrupt the financial services industry. Here to discuss this and a lot more, Devin Banerjee. Devin, thanks so much for sticking around with us this morning.
Absolutely, Jeff.
And it's certainly great to have you back from your recent road trip to India and London, England. So in the last segment, we talked about the brokerage industry consolidating, Schwab, TD Ameritrade. Much of that was precipitated by the firm Robinhood, which is, as to your point earlier, 6-year-old startup. No commissions really facilitated this market disruption. But a lot of news for Robinhood this week, in addition to the Schwab Ameritrade merger.
Yeah, absolutely. Robinhood is one of the most eager disruptors in financial services. And I think it's realized, given the news this week, that it's not as easy to disrupt a real traditional, established, and regulated industry like banking. So Robinhood was seeking a national bank charter here in the US. It filed that application in April, about 7 months ago. This would allow it, of course, to take on deposits, customer deposits directly, to more easily establish things like checking accounts, saving accounts, debit cards, credit cards, etc. So this week we learned that Robinhood pulled that application for a bank charter, again, just after 7 months. We're not sure why. Robinhood says it voluntarily did so, but that could have been for many reasons. It could have gotten some signals that the charter would not be granted. It could have found difficulties or questions along the way. It had started a wait list for a checking and saving account like product. Perhaps the demand there was not there as great as it expected. We're not sure exactly, but what it really shows, again, as I said at the top, is that disruption in this industry is a bit tough. So what happens going forward? Well, the kind of established model that we've seen with fintechs and traditional institutions is a partnership model. If you think about the Apple Card with Goldman Sachs, for example, Apple handles the top of funnel, the onboarding, the customer experience, and Goldman is the pipes behind it, the regulated chartered bank behind it. We're seeing this now with talks between Google and Citigroup for checking account-like products for users of Google, for example. So this is not probably the preferred route, I would think, for some fintechs or eager disruptors, as I mentioned, like Robinhood. One of the most interesting comments on the platform on LinkedIn when we featured this story was from Yusuf Foster, and he was saying that these companies have been based on partnerships. Insurtechs and fintech companies have been based on partnerships for a long time, and really they realize they end up becoming the very thing they sought to disrupt, which is to say they have to answer to regulators eventually, and it's not so easy to just flip an established industry on its head. Some really other interesting comments, on the platform saying it's just a matter of time before the industry and regulations change as well. It may not happen as quickly as fintech companies would like, but in a world that's increasingly being made efficient through technology, industry and regulators will have to adapt. We've seen that a little bit with talk here in the U.S. From the OCC about creating a fintech charter, so a kind of special charter for fintech players that are kind of on the fast track. Actually, a court ruled just in the past few months that the OCC didn't have the authority to create that charter, so that was another roadblock. But we're seeing more talk from regulators of trying to adapt as well as the entire industry adapts.
Yeah, it seems to me, and to get your perspective on this, number one, could Robinhood be partnering, like you suggest, with Apple and Goldman, as an example? Could they follow suit and partner with a banking institution? Because we have seen a lot of online banks get created. I can name several of them off the top of my head, where a lot of people like to go online. They're searching for higher yield. They get better certificate of deposit rates, as an example. And so maybe that is an interim step. Additionally, I wonder if, to your point earlier, if the regulations just need to be updated. I mean, a lot of the regulations that we're discussing have existed for for decades, and maybe have not been updated for this recent wave of technological innovation. So maybe it's time. We've talked about privacy on this show and with you and others, and you see California passing privacy regulations. You see European Union doing it, and others at the federal level doing it. And so those rules are getting updated. Maybe it's time to also update, the FDIC insurance and some of the other things to allow some of these more innovative ideas. And, that being said, we all know that there's a little bit of a protective aspect to regulations, protects the existing entities. But it just seems like, Devin, to me, that there's a lot of innovation. And with innovation, it seems like you need innovation and regulation.
Yeah, I would absolutely agree that is what the conversation is revolving around, is that regulators need to adapt as well. Now, of course, regulators say that a lot of, even though, as you said, the rules have been in place for a long time, their enforcement has been quite strict. The bar has been quite high since the financial crisis, which was only 10 years ago, about 10 years ago at this point, 10, 11 years ago. And so they would say that they are kind of still in protection mode after the crisis, and thinking about the end customer, the end user. So, a lot of kind of voices from different sides of the table with their own vested interests. But you're right that disruption and innovation is happening at such a rapid speed and at scale now, and regulation has certainly not adapted. I would agree.
Yeah, last question. I've been reading that some of the technology firms, for example, Google, Amazon, we know that Amazon has gotten into a partnership for healthcare, but we know that Google has looked at the finance industry, and I'm wondering if that's another area where we could see these big tech firms that we've talked about in other segments about privacy and monopoly and all these other questions that arise from regulators and legislators. But I'm wondering if these companies jump in as well. And they employ a lot of lobbyists, Devin. Amazon and Google, they are not, they definitely contribute significantly to lobbying efforts in Washington, D.C. I wonder if they have plans for the future in this arena.
That's absolutely right. About 2 weeks ago, the Wall Street Journal broke the story that Google was seeking a checking account type of product in partnership with Citigroup. What was interesting about that story, actually, that we did feature on LinkedIn as a trending item, is a lot of the feedback there was around privacy, as you alluded to. And a lot of these big tech companies actually are really on the down and out, or at least on the down, in terms of user trust regarding privacy. So a lot of people came out and said, that sounds great. I use Google, but I'm not going to hand over my money and all of my transaction information and data, which is what Google wants, to a company like Google. So I think users are actually waking up and thinking more of the pros and cons of different service providers when it comes to their financial services.
And by the way, just to be fair, I mean, not only do they distrust some of the tech companies, and some of it's rightfully, rightful, but there's also distrust of major financial institutions. There's distrust of government. I just get the sense that no matter where you turn, I mean, you've got to be able to trust someone, and maybe there are ways to kind of work together between the Googles and the banking industry to create a better landscape for investors and for consumers. And I think that ultimately is what we're all after. Devin, it's a pleasure seeing you back in San Francisco, California. I'm sure you were happy to visit your colleagues, but you're also happy to be back with your friends and family here and colleagues. So welcome back and enjoy the rest of your week. And we'll talk to you later in the week on the podcast.
Sounds good, Jeff. Take care.
And folks, that wraps up this episode of BRN AM. We're back at it again tomorrow with our Technology Tuesday. Do you have a topic or someone of interest that you think we should interview? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, so much more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.